The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Here are your headlines. Japanese stocks jumped more than 3% to start a holiday-shortened week as a stabilising yen helps boost market sentiment. Republican presidential nominee Donald Trump discusses immigration and the economy in a freewheeling conversation with billionaire Elon Musk on X. But the event is marred by technical difficulties.
Crude prices pull back following a 4% jump amid increased tensions in the Middle East, with Israel's military reportedly put on high alert. And Pandora hikes its full-year growth outlook for the second time this year, withstanding weakness in the wider luxury sector. We'll be speaking to Pandora CEO Alexander Lashik in the first on CNBC interview at 8:30 CET.
We're digging into some of the jobs data this morning from the UK and what this means for the Bank of England. Crossing this morning from the ONS, saying in July, 24,000 more people were in payroll employment when compared with June. The average weekly earnings, so as we talk about what sort of heat we're still seeing in the wages component, up 4.5% year over year in the 3 months to June. A Reuters poll saw this slightly higher at 4.6%, so coming in under that number. Ex-bonuses on the earnings on a weekly basis, 5.4% over the year in the 3 months to June. This is bang in line with the Reuters forecast. The July claimant count, 135k month on month, 97k up. The 3 month view is what we're seeing on that line. On the jobless rate, this was expected to rise, but it is not rising to the 4.5% that was estimated. What we're seeing for the 3 months through to June, in fact, was a rise in the jobless rate to 4.2%. So again, a little bit more strength here than expected. What it is telling you, though, is that we're watching closely what this means on any turnaround, because the market here and elsewhere is still seeing consistently strong job market. Don't forget, it was the job market that spooked a lot of traders, investors stateside recently. So I think as we watch the UK market here, we are still seeing some strength in those wages components, but we're not seeing the jobless rate lift to a level as far as the market was expecting.
Yeah, so one thing is, of course, they'd want this to ease, of course. We had been asking about the services inflation, wages inflation, all being very important factors then to that CPI print. Of course, the CPI print this week that we're also getting out of the UK will be the first since the Bank of England actually cut interest rates for the first time, that 25 basis point cut. And this will be data that they'd then be looking toward to say, well, yes, we're now expecting a figure that's perhaps high on the overall inflation print, but what does this data mean? As you can see then, a slight spike up as well in the currency.
Get into that, because this is really interesting. Dollar's been in the driver's seat for so long. And now as you get data points out of individual economies, and this one suggesting, look, we've had a real swing towards the story that the Fed is going to be cutting. It could be cutting by 50 basis points, slight unwind of that in recent days. But now as you get a narrative, well, where are other central banks in this game versus the Fed? This data point suggesting, well, we're not seeing a collapse in the labour market here. So sterling dollar rallying 127.95. That's a step up of 0.25%. And I think to see a move like that against what has been a mighty currency in recent years, that is a genuine move intraday.
It certainly is. I mean, we had 129 not so long ago as well. So really interesting to see how far that actually goes. Let's check in, though, on this overall market picture for you then. And let's get off to Asia as well then. You're seeing a broad positive sense here, but if you actually look into the weeds of it, it's marginal. The Nikkei was on holiday yesterday, right? So you're seeing perhaps that holiday trade come back into this market picture. So you'll see even the topics managing to gain nearly 3% as well overall. Again, it is a lot of those tech players, even the financial stocks. You're seeing Rakuten going up around 8%, Trend Micro around 6% to the good as well. So there is positivity, but it is just marginal. It's pretty much the same sentiment we saw out of Wall Street as well yesterday. Pretty flat stance. All eyes are headed towards that CPI print out of the States. Then we do have more data, of course, course, to really look behind, to look ahead to, should I say. So that is what the market will probably focus a little bit more on overall. And this is what the topics Nikkei 2 chart pretty much just looks like overall. There's a significant uptick that we saw. Then, of course, you saw that big decline then at the beginning of last week. Now, trying to come back a little bit. And if one was to zone in just a little bit on this part, you'd see that the market is beginning to find some leverage to get back to levels pre that drawdown that you saw then significantly so last week. So much so that Japan's parliament is even said to ask the Bank of Japan just a few more questions. The governor, Kazuo Ueda, will be asked these questions and will be asked to attend a special session on the central bank's decision to hike rates, according to a Japanese lawmaker. Now, that session, expected later this month, comes after the BOJ's surprise hike, coupled with U.S. economic concerns, which all led to a significant market turmoil that you saw just last week. Dollar yen then pretty much stable, really, in comparison to what we have seen, of course, across what has been a currency that has moved quite dramatically from the highs of 161 right through to around 141 as well, just last week, Karen.
And let's switch to the politics. Got a lot of noise. It was a headline act, but just how key was it, really, as we talk about the politics in the lead up to the November race? In a wide-ranging, largely off-the-cuff interview with Elon Musk, Republican presidential nominee Donald Trump vowed to crack down significantly on illegal immigration while hitting out at the Biden administration over the state of the economy. The pair also touched on energy policy and last month's assassination attempt on the GOP candidate. Musk, the billionaire CEO of Tesla and SpaceX, also seemed to pitch himself for a role in a prospective Trump White House to help oversee government spending. On the economy, Trump said American voters were pent up with anger at the Democrats, blaming them for having let inflation spiral.
The thing that they really is making them angry is what Kamala and Biden have allowed to happen to the economy. It's a disaster with inflation.
Meanwhile, Musk attacked the Biden administration, blaming it for the U.S. fiscal deficit hitting record highs and offering Trump some advice.
We need to reduce our government spending, and we need to re-examine. I think we need like a government efficiency commission.
The Trump-Musk interview started nearly an hour late after X was plagued by glitches and technical errors. Musk said the site had been targeted by a cyber attack. CNBC has been unable to confirm that claim. Now, once the interview was underway, it was said that the attack demonstrated how people are opposed to simply hearing Trump's opinions. Vice President Harris's campaign said Trump's, quote, extremism was on display during the interview, saying his campaign was in service of people like Musk. Now, CNBC has learned that Brian Deese, the former director of President Biden's National Economic Council, has started advising the Harris campaign as it puts together its policy plan. Harris has also called on Mike Pyle, Biden's former deputy national security advisor for international economics. The Democratic nominee says she will unveil her first formal platform in coming days, with its message focused on lifting the US middle class. Goldman Sachs says the US presidential race has become an essentially even contest after Harris saw polling gains in recent days. Analysts at the Wall Street lender say a Democratic sweep would likely lead to significant fiscal policy changes, raising tax on high-income households and companies, while the scenario of a Harris win with a divided Congress would result in much less change apart from the expiration of some tax cuts for higher-income households. Elliot Hentoff joins us now, head of macro policy research, State Street Global Advisors. Elliot, it is a big one for the markets as we count down to November. How are you thinking about Harris or Trump and the impact on the economy?
Well, we are spending quite a bit of time with it because it's the U.S. macro policy mix matters so much for global financial markets. I think the big shift, really, I know the presidential horse race is very tight. Two things that derive from that. The first is there should be a little bit of an uncertainty premium that starts to sneak into markets. You know, until Q3, markets typically ignore the elections, and then over the summer it starts to build up. And until markets can price the outcome, that uncertainty discount kind of keeps a lid on risk assets. But the second big movement really is because Harris replaced Biden, that the odds of a divided Congress have gone up a lot. And therefore the chance of a significant fiscal expansion have receded. And that means that some of the moves in the bond market should be a little bit tempered.
Interesting. Fiscal expansion receded, but we're not talking about any attempts to tackle government spending. And Musk was right to pick up on that point, because while it may not have mattered for bond markets, it gets to the point where I think many of us are concerned that it will have an impact at some point. And the reality that, look, fiscal spending doesn't always equate to economic growth. In fact, it can crowd out other participants.
Well, we spent a decade about how central banking, monetary policy was the only game in town. I think the coming years we will focus a lot on fiscal policy, fiscal dominance, and the fact that that's going to be a market driver. Now, with regards to the US, the problem in the US is that revenues as a share of GDP are historically low. So yes, of course, you can adjust expenditures, and there probably has to be some review. But ultimately, tax revenue will have to go up in some shape or form, either through the backdoor expiration of past tax cuts or more explicit revenue-raising programs. There is no alternative to that. The fiscal problem is going to get acute in 2025 because debt servicing costs are going up. Remember that the average maturity of treasuries is 7 years. That means half of that has to be refinanced at higher interest rate costs and no longer kind of the zero interest rate environment that it came from. So that problem, even if you have kind of fiscal stability, is going to get worse.
What do well-timed interest rate cuts look like right now? I mean, you know, that's pretty much what we're seeing in your notes, but what does well-timed mean right now? Because the Fed will feel like they've navigated this as well as possible.
Well-timed, I think, at this stage means they got to go in September. Markets are expecting it. I think when you look at the cracks in the U.S. economy, the economy is it needs that easing. Rates are clearly in restrictive territory. It's starting to cause pain and damage, and therefore the central bank has to respond to that. Well-timed, I think. We are not in the camp where we think there needs to be an emergency cut or a 50 basis points cut, but I think the beginning of the rate cutting cycle that we've all kind of been waiting and hungry for quite some time.
But is that 3 cuts this year, or is that 2?
That's 3. Okay, that's 3 this year, and then a few more next year.
Yeah, but then ultimately still a lot of volatility, as you made note of with the election, with these interest rate cuts still in play for the most part of this year. A lot of volatility still to come. And then you just look at this period that we're in, retail data, retail sales numbers as well, still have NVIDIA to come, plus Jackson Hole, etc. Is that something that the market then is gearing itself up for, you think?
Yeah, I was speaking to Karen about this. You have a situation where you're primed for more volatility, partially because you've had ultra-high equity allocations to begin with. You have summer liquidity being fairly thin. Positioning has been stretched, and therefore very little small triggers can give you outsized volatility, whether that's macro data readings, whether that's some individual corporate performances. It doesn't take much to shift in markets and lead to repositioning and rebalancing very quickly. Something that we saw 10 days ago. Fundamentally not a macro event. That was, from our perspective, a pure investor positioning response.
Yeah, I was saying it's fascinating as we had that market event, focus on the yen carry trade, focus on the US economic story, but also in the backdrop was a lot of commentary around the politics stateside, which is just fascinating how early on it's come into the mix. When it comes to your cause, and just to close off on this, you say a big shift with Kamala's candidacy is that the odds of a divided Congress have gone up a lot. Just walk us through the scenarios that you see in terms of the outcome.
Yeah, I think a little bit poorly understood is that if the polls are 50-50 in terms of outcome for the presidency, that favors the Democrats, because where they have to pick up districts are areas where they have, in a 50-50 national, they're actually +2, +3. And so therefore, as long as the presidential stays close, the Democrats are favored to win the House. And that obviously means a divided Congress, because the Senate is virtually certain to go Republican. Any
view on the swing states and how those come into play and how targeted the Democrats can be with Walz now on board?
In our dashboard, there's only 4 swing states that matter. It's the 3 Midwestern plus Arizona. We think it's very, very close. Again, we know that small things can shift the outcome, and therefore that uncertainty should be present, because markets do not know the outcome. We do not know the outcome for certain, and so therefore we have to price the relative odds of different outcomes, and that means uncertainty and a discount for now.
Yeah, very interesting conversation. We're going to continue to have a chat with you as well after this ad break, so please do stay with us then, Elliot. Elliot Hentoff is Head of Macro Policy Research then at State Street Global Advisors. Now, coming up on the show, medium-term inflation expectations fall to their lowest ever level in the New York Fed's latest consumer survey. We'll have the details next.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
Ukraine's Air Force says the entire country is under fresh air raid alerts after Kyiv said its forces now control around 1,000 square kilometers of Russia's Kursk region. In a televised meeting of defense officials, Kursk Governor Alexei Smirnov said the Ukrainian army has advanced as far as 12 kilometers into the area, with more than 120,000 residents evacuated. NBC News has not been able to confirm the scale of the territory controlled by Ukrainian forces.
Now, Russian President Vladimir Putin vowed a worthy response to Ukraine's advance, saying the move was intended to strengthen Kyiv's position in future peace talks with the help of its Western masters. He also accused Ukraine of attacking civilians.
It appears that the enemy is aiming to improve its negotiating positions in the future. Well, what kind of negotiations can we even talk about with people who launch indiscriminate strikes on civilians, on civilian infrastructure, and try to create threats to nuclear energy facilities? What can you talk to them about?
Sylvia joining us for a little bit more on this story now. Sylvia, as well, this is a story that, of course, the president of Ukraine has actually also confirmed that they indeed had this offensive in Russia. Just give us a little bit more color with regards to the latest on this situation.
So we were discussing this topic yesterday, and what we have witnessed over the last 24 hours is further escalation in these tensions between Russia and Ukraine, with now Ukraine putting even more pressure on Russia. And indeed, with Ukrainian officials confirming that they have captured 1,000 square kilometers of Russian territory, this in the Kursk region. And at the same time, though, Russia has been very clear and has vowed a tough response. We have seen in the meantime further airstrikes on Ukrainian soil. Just to give you an idea, Russia attacked Ukraine with 38 drones as well as 2 ballistic missiles overnight. So clearly these tensions just keep on growing. However, there's a new momentum in this war, with the pressure now coming more from the Ukrainian side. And this was very clear yesterday when we heard from President Zelensky as well. Here's what he had to say.
It is only fair to destroy Russian terrorists where they are, where they launch their strikes from. Russian military airfields, Russian logistics. We see how useful this can be for bringing peace closer. Russia must be forced into peace if Putin wants to continue waging war so badly.
So I would like to share also this comment with you from a U.S. Republican senator who was in Kyiv on Monday, and this is according to Reuters. This U.S. lawmaker made the comment that when it comes to this incursion of Russia, what do I think about Kursk? Bold, brilliant, beautiful. Keep it up. So that's the message from one U.S. official, and we know that the position from the United States is also very important in this context. Yesterday as well, we were talking about the comments from the finance minister of Ukraine, suggesting that the fact that U.S. aid has been slow has put pressure on the finances of Ukraine. And in that context, I also want to show you these remarks from a spokesperson from the Ukrainian Ministry of Finance, who told us yesterday afternoon that they have so far received $3.9 billion from the United States. This was the first tranche of the announced support, and they anticipate the next disbursement in the fall. And we know that all of these dollars will be very important for Ukraine, particularly now that we witness a new momentum in this war, guys.
Sylvia, thank you so much for that update. Then let's just quickly turn our attention to where markets look stateside as well. Then as we head towards more data points, of course, PPI data out of the US is due a little bit later on today. We did actually have budget deficit numbers out of July where more than $1.5 trillion. That's the budget deficit for the year then for the US. So we're focusing in on a little bit more data points. It looks like we could be headed for a positive open.
And let's come back to our guest, Elliot Hentoff, staying with us, Head of Macro Policy Research, State Street Global Advisors. Elliot, we are seeing a lot when it comes to the geopolitics in terms of Ukraine now taking the offensive behind enemy lines in Russia. We're closely watching whether there could be a retaliatory strike on Israel. What do you make of the two conflicts, the potential for this to have still some impact on markets?
The short answer is limited, and you can see that. You had colleague from the oil industry on earlier. Oil is incredibly well behaved. The classic macro transmission via commodities is not impaired. What I think is important to point out here is the Ukraine conflict is clearly there's an escalation because of also the U.S. election dynamic. Both parties understand that it's an opportune moment to still set boundaries in the ground before there's a potential change in the White House or not. The odds of a de-escalation post-November are growing. They're growing on Ukraine's side because clearly they've managed a surprise counterstrike, so they have some bargaining power. And even in Russia's case, if you know it will be a continuity in the US policy, then maybe in 2025 you seek some type of de-escalation or stabilization. In the Middle East, it's the opposite. I do not see a mechanism to stabilization right now. And while there's no relevance for markets, that does mean that as you have conflicts brewing, there's surprise effects that can flow from that. But currently, I don't see a direct spillover effect.
Yeah, one of the issues as we first were watching what was happening around the Gaza Strip was that if there was a broader conflict that unfolded, it would bring more risk to global markets. We still seem to be on a nice edge when it comes to that story. We're closely watching retaliation here, what Hezbollah is doing, not just Hamas, what Israel faces in terms of Iran. If we do see a broader conflict, what potential, though, does that still have in terms of roiling markets?
Again, I think the straightforward look is always, okay, conflict, geopolitics, oil. But I think that's a bit simplistic. What has surprised me actually since the original attack in October is that risk premium generally, you would imagine that risk premium should be widening generally on vulnerable areas of the world where you could have an increase in geopolitical tension. That has not happened. So in plain English, the odds of a crisis in East Asia and Taiwan Straits or in Korea has not gone up in terms of market pricing. And you would have imagined that instability in one world begets instability elsewhere. But we do not see that priced.
Yeah, and I suppose that's actual surprise then. And that's why you're seeing some of these oil prices now hitting $80 a barrel. And we've spoken about that a little bit earlier on. But why is that not happening? Why is it that one situation isn't begetting sort of the instability instability that you might see in another place that in the past used to actually be a common feature? And what does that mean then for markets? Are they just beginning to price these things in a little bit further and a little bit more?
I would not, unfortunately, no, that's not the case. What's simply happening is that the transmission path is not there. So Russia shock, Russia used to supply almost a fifth of Europe's gas. That has obviously come down to very low digits. So that we had the macro shock there. In the Middle East, are we worried about Saudi production being knocked out? No, we're not. Markets are saying, no, that is not going to happen even in a regional war scenario. Worst case, you get 1 million barrels of Iranian oil off. But we have spare capacity just in the GCC of over 5 million barrels a day. The highest it's ever been, doubled its historical average. So it's hard to get nervous about it unless you think the war spills beyond Iran's borders into the heartland of oil production in the Gulf. Very hard to see that path.
Yeah, and I suppose that is the question mark as to why it had been so muted for some time, particularly in that oil market region as well. If the tensions aren't actually going up any further than where they are right now, and even if you do see an offensive continue then from Iran as well into Israel, is there a case that the market needs to make for understanding that a little bit more, and then also understanding new leadership, if that was to be the case, in the US in terms of whether it's Trump or Kamala Harris?
Yeah, I think the the simple transmission path via commodities is not the way it would play. The way it would play is the indirect one through US elections, for instance. You basically get an escalation in the war. It looks again like another foreign involvement for the US in the Middle East, and it changes the dynamics in the campaign, and then suddenly we get the repricing in US bond markets and so forth. That's the transmission path for how the kind of the escalation in the Middle East would play out.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.